Mr. Dharamshi, what are your expectations from the budget, which is now just about 20 sessions away? Mostly what the government could do possibly in terms of reducing interest rates, cutting GST costs, and of course providing a very, very strong thread ahead is the RBI. Now, what do you think are the 2 or 3 major steps that the government can take to benefit corporate India and capital markets during the budget next month?
Yeah, no, so first of all, we need to understand that budget incrementally has been less and less an impact on the markets. Not to say that it still has importance and it will continue to have importance, but lot of steps tend to be taken outside of the budget. So the incremental impact of budget tends to be lesser and lesser. But having said that, what markets will be looking for is continuation of policy. See, we have been in this will be year 12 or budget number 12 of this particular government, and this is the longest period post our capitalistic adoption of capitalism in 91 that we have had the most stable policy framework. Right or wrong, whatever, but it's been very stable. So from that perspective, this government of the day has always been focused on managing the balance sheet and always been focused on supply side reforms. Last year we saw incrementally some change over there where income tax cuts were announced and direct tax as well as indirect tax cuts were announced. Now this is the first time that some sort of demand stimulus was also given. It is an admission of the fact that central government capex driven economy had run its course. The impetus given during COVID had run its course, and there was a need to provide some kind of a stimulus for the cycle to continue. And that's exactly what the government has done. And I do believe that continuation of those policies, incrementally consumption oriented policies, incrementally spending will be there from the central government, but it will remain more targeted. It cannot be the needle mover. The year from 21 to 24, the capex growth was almost 25-30% in the central government's budget. That will not be the case. This time we are anticipating somewhere between 8 and 10% kind of central government capex increase is a more sustainable number going forward. So it will track the nominal GDP growth rate rather than exceed that. So other engines of growth need to be fired up, and that's what we will be looking for from the budget, that more and more new engines of growth get fired, whether it is the broad basing of the real estate cycle, whether it is the consumption cycle, whether it is the rural economy. Those kind of engines, if they get fired up, then the cycle can continue forward.
If you like the video, do like, comment, share and subscribe.